Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 189 of the Independent Advisors Podcast, where Mark McEvely and Matt Jessup bring you everything you need to know from the past week in the world of financial markets and financial planning. This week, as viewers may be able to see on our YouTube channel, it's you have neither Mark nor Matt. They're both preoccupied with work events. So filling in, you have myself, Nick Whitaker, Director of Research at Jessup Wealth Management, and one of our favorite and most esteemed members of Jessup Wealth Management, Aaron Kramer. So,
thanks for that lovely intro, Nick. That was great. Appreciate that.
I really like to drone.
You really
on,
sold
so
it.
We're really selling it. So this will be good. As everyone knows, we start off with a little bit of pricing. This data is from Y-Charts. So the S&P 500 month to date is down 2.1%. Year to date, it's up 3.9%. The Dow Jones Industrial Average month to date is down 3.1%, and year to date down 0.3%. The NASDAQ Composite is down 0.7% month to date and up 9.9% year to date. The iShares Russell 2000 ETF, think small caps, is down 1.8% month to date and up 7.8% year to date. And the Vanguard FTSE All-World ex-US ETF is down 3.4% month to date and up 5.0% year to date. Checking in on the Treasury markets, 3-month Treasury rate is currently sitting at 4.84%. The 2-year rate is at 4.66%, and the 10-year Treasury rate is at 3.93%. So a little bit of movement in the Treasury markets, but we are still inverted on the short end of the curve. No surprise there. Jumping right into the big headlines and the current events, I'm just going to do a quick one for listeners, and it's a little bit of Fed speak, which has been dominating some of the narrative of the market as of late. St. Louis Fed President Bullard, he's a non-FOMC voter, FYI, told CNBC earlier this week that the U.S. economy has been stronger than the Fed thought, and he thinks that the market may be overpricing the risk of a recession in the second half of 2023. I'm gonna actually jump into it.
I like that.
Yeah. It could be good, could be bad,
right?
Depending on how the market reacts. But I'm actually going to jump into this a little bit later in the podcast with some of my research. So
great.
Unless you have anything to add to that little bit of tidbit of news, we'll just jump right into it.
Just from the pricing standpoint, I liked it to see the more aggressive areas are leading the market. I think that's a good sign, in my opinion, and bodes well for hopefully this year, right? So that's exactly what I would want to see, is the NASDAQ and small caps kind of leading the market.
Small caps, even the X-World or the ex-US ETF, so the all-world, which does have, that is going to factor in big foreign national companies as well. So it's not necessarily like an emerging market. They're not the same thing, but even still, having some of that as well, I would say is positive.
Absolutely.
Yeah.
Good. Well, if you're all right with it, I'll kind of jump right into tweets, articles, and research from this week. So I've got a few good ones here.
Take us away.
All right. So the first one is going to be an article from Kitces.com. So Michael Kitces is a blogger and a financial planner, very smart guy. And this article is actually written on his blog by Henry Moreland on February 15th, and its title is Deathbed Drawdown of HSA. So I'm getting a little bit morbid here, but to start off the podcast, but one thing to think about is when HSAs are funded, there's kind of two options that you have that this article talks about. It's you can fund it and use it as you go. So if you have health expenses while you're young and they pop up, you can actually use that money to pay for health expenses, right? The second option is to contribute to that HSA and let it grow over time, right? So maybe you pay the smaller things out of pocket, and if you don't have any major medical expenses, that HSA, if you max it out for several years, 10, 15, 20 years, it can get pretty substantial in size, right? So the article talks about what are some of the kind of advantages and disadvantages of the HSA being kind of, let's call it, overfunded? So the main reasons it could be advantageous to have a good chunk in HSA by the time you're 65 or retiring is because you can't contribute to it anymore once you're on Medicare, right? So the estimated health costs several years out in the future, it's estimated to be about $315,000 for retirement healthcare expenses going forward in the future. So it's kind of a crazy stat that 15, 20 years in the future, it could be that expensive for healthcare expenses. But we've talked about inflation, but healthcare inflation has kind of been at an even faster clip, right? So one thing to think about with HSAs is if you do have kind of, let's call it a super funded HSA, and you can't spend all the money, what do you do with it, right? So there's several options when you pass money on to the next generation in an HSA, but a better option that the article talks about is the deathbed drawdown, right? So essentially the deathbed drawdown is reimbursing yourself for healthcare expenses you've had your entire life. So essentially, if you can keep track of receipts, you can keep track of larger medical bills towards the end of your life, you can pretty much, anything that you can justify with documentation, you can completely draw that HSA down, get that tax-free money out without paying penalties and passing it on to the next generation where it's not as tax advantaged. So we have a couple charts here on the taxation of HSAs at death. So I'll just run through one here. So essentially, if an HSA passes on to a beneficiary that is a spouse, it can remain in HSA, okay? And who is taxed? Nobody's taxed, and that's great. So if you pass your HSA on to a spouse, it's no problem. It stays tax advantaged. If you pass it on to a non-spouse that you're passing, it cannot remain in HSA, and the beneficiary is actually taxed on that money. So it loses its tax advantage status. And finally, if you pass it on to your estate with no beneficiary or anything like that, your final return, tax return, will pay taxes on that amount. So I think the theme here is I would say you want to fund an HSA, but you don't want to overfund it too much to where you're losing some of the advantages to essentially what it is, right? Which is for healthcare expenses. So
right.
The deathbed drawdown is a really good strategy. Say if you have $50,000, $100,000 in an HSA, which is certainly possible nowadays. They've been around long enough where people can actually start to grow them pretty
Especially
good with investing.
If they've been invested
Exactly.
over 10 years.
Exactly.
Or
So
more.
yeah. So if let's say your HSA is funded or overfunded, make sure you're keeping track of all those receipts, all the medical bills that you have. I know it's a little bit easier nowadays with what's called My Chart and all the things that you're paying.
I was going to say that, and for anyone who is, because that's the first thing I thought of is, the receipt tracking. I like an internal groan.
Yeah.
Jumps to mind. But I know in a few of the HSAs I've had in the past, just through different employers, the receipt tracking is a lot easier nowadays with software. So for anyone who's listening who had that groan, is like, I'm never going to track all my receipts
For 20, 30 years, right?
Double check, and obviously you'll need to look at your own HSA and the account and the software and everything. But I would venture a guess that it's a lot easier than you would think, because with technology nowadays, the software is going to be doing your receipt tracking for you. It's just all in the same place. Just need your username and your password. It should all be there.
Absolutely. Yeah, that's a great point. Other than that, any other thoughts on the HSA deathbed drawdown? I think it's a good strategy if you can come up with that documentation. So it's better to use that money essentially while you're living rather than passing it on to a non-qualified beneficiary is the main point.
Yeah, that makes sense to me too. I mean, that's what it's for. And as you mentioned, healthcare expenses in the United States are not going away anytime soon. They're going to grow. So I feel like most people will be able to use them in their lifetime
without being overfunded.
I would unfortunately
100% agree.
But true. So what else do you have?
All right, next one I have is an article by Ben Carlson. I reference his stuff all the time. He's a great great writer. His article is called "Ongoing Stimulus in the Economy for Years to Come," and his blog is a wealth of common sense. And this was on February 20th, so just a few days ago. So what this article says, I'm going to paraphrase it essentially. I'll read a couple paragraphs out of it, but it's a bit lengthy, and I don't want to read the whole podcast. So essentially what he's talking about is when he bought his first home and how low rates have been in mortgages, specifically for kind of pre-pandemic and pandemic levels, right? Yeah. So he says when we first purchased our new place in 2017, I think rates were around 4.5%. So he said it's a no-brainer to refinance at 3% during the pandemic when mortgage rates fell to the floor. Rates got so low during the pandemic that the monthly mortgage payment we now pay is roughly $150 more per month than we were paying on our very first payment back in 2007. Okay, so what he's talking about is when they bought their first home, 2007, 10 years later, they bought their upgraded home. And he mentions that's despite the fact that the price of our new home was 150% higher than their first home. So it's really pretty crazy how
150%.
Yeah, so I mean it's more than doubled, right? And the payment was $150 more. So he goes on to say, we didn't put a lot down on the first home and rolled all the equity from our previous home into the new house. We've paid down the mortgage as well. The taxes, insurance, and upkeep are obviously more expensive on our current home, but this just goes to show how low mortgage rates got in 2020 and 2021. So he says we were able to lock in extremely low fixed debt costs and our biggest monthly budget item, and we weren't alone. So I really like these next couple stats that he's going to throw out here. It's estimated 1/4 of those who currently have a mortgage have rates of 3% or lower. And then 2/3 of those with mortgage debt are at 4% or lower. So this is, I really like that he makes this point because mortgage debt is the majority of household debt across the U.S. So
I'm going to jump in just to make sure I heard that right. So you're saying, let's call it 66% have mortgage rates. 66% of home owners have mortgage rates sub 5?
Sub 4.
Sub 4.
4% or lower.
Wow. Yeah, that's a lot.
It's pretty shocking. So it makes sense. His title of this article is "Stimulus for the Economy to Come." So I think
years
that's
to come. Yeah.
I know we've seen inflation start to roll over and slow down a bit, but I do think this is an ongoing factor that could lead to longer term inflation. And I think why the Fed has had to raise so aggressively is because they realize things like this, that most people's biggest expense, right, is their home, right? And if you're sub 4 and you're in a reasonably priced home, it's going to be a lot more discretionary spending than, say, 10 years ago, right? Or now if you're buying a home when rates are at 6.5%, 7%, right?
Yeah, a drastic amount of discretionary income.
Right. So
that's a really interesting point.
It's a really interesting point.
Yeah.
So, and home ownership rate is currently hovering around 66%, is what he says in the article. So, majority of people are homeowners across the U.S., and that's I think the point he makes that it's a stimulus ongoing is very accurate. It's any other thoughts you have on it? I think it's a factor that maybe not everyone's considering with inflation right now.
Yeah, I had not thought about that, and I didn't know those numbers. It makes a lot of sense, especially with some of the generational shifts that I'm trying to think through some of that too. With maybe you have more boomers retiring and maybe going into smaller homes, and then you have the millennials finally starting to purchase homes and kind of leaving the suburbs a little bit. So
yeah, I know.
Or I should say,
home
leaving
ownership
to the
definitely
suburbs a little bit.
Increased across COVID time
Plus
periods because
pandemic pushing people into
the suburbs, less renters, more buyers.
Interesting.
So, and if people locked in rates under 4, I mean, my rationale would be, why would you leave that, right?
It's tough to leave it.
So not everybody's going to have that same mentality, but
tough to leave it when you see what leaving it does to the bottom line.
Yeah, it's a huge hedge against inflation, and if you can be under 3-4%, that's pretty pretty amazing. But yeah, I'm just curious how that's going to impact long-term inflation and the economy overall. Okay.
We'll see.
We
That's a
shall.
good one.
All right, I got two more for you. These ones will be relatively quick here. So this is a tweet by Bespoke Investments on February 22nd. And this is a chart of natural gas futures, front month futures going back to 2000. And nat gas is currently sitting at just about its lowest level since COVID, the major sell-off there. So the tweet says, if someone showed you the charts of oil and natural gas and gave you no other information on the state of the economy, where would inflation rank on your concern level? So I think that's a pretty interesting chart. Any thoughts before I kind of kick it off?
Not too many right now. I've not been reading as much on the energy space as of late, just because of some of the pullback we've seen as of late. But these commodities, particularly nat gas, oil, this type of price action is normal.
Yeah.
This type of volatility and these types of swings on a year,
Couple month basis.
Yeah. Year to 2 year basis, even a couple month basis, or short-term volatility. But when you look at this chart, you kind of see big peaks and valleys about every 2 years. Now, granted, the one we saw recently is a little bit more noticeable. And I'd say that's pretty normal for the commodity market, especially nat gas.
Yeah, my only thoughts were is I do think this is a positive thing for inflation. So kind of being flip-flop each side from the stimulus from mortgages being kind of a long-term potential negative for inflation. This is a short-term positive for inflation. So, I mean, having pretty much record warmth throughout the winter drove prices down in nat gas. There was just too much supply, essentially. So prices went from $10 a million BTU to $2 a million BTU, which is a pretty drastic move since August, right?
Yeah, it should help things.
I think it'll definitely help things. If you just think about energy prices, even your own home electric bill in the summer compared to where it's at now, that's definitely a driver to help people in inflation. And I think overall I think it's a positive thing. Obviously not if you're a nat gas driller or a producer, it's not great for them, but for the overall economy, I think it's probably a positive thing that it's slowed down.
There's a reason some of those stocks have cooled off.
That's right. All right. Last tweet I have here for you, again from Bespoke. I love their stuff as well. They always have really, really excellent charts. So this is a chart on 2/21, February 21st, on the existing home sales, and it's a pretty dramatic drop in existing home sales. This chart goes back to 2000, and the year-over-year change in existing home sales is, correct me if I'm wrong, looks like 70% approximately.
It's substantial.
It's big. Listeners will see the charts, and it's dramatic. Mental math's not always my best, but
looks about 70. I can't see the exact hash marks, but yes, 70%.
Pretty massive year-over-year change in existing home sales. Again, a lot of that's rates going up is slowing. Supply is pretty much at zero right now, basically. Yeah. And rates, I think, are forcing people to kind of stay put, is my feeling. So, again, this is, in my opinion, another positive thing for inflation. Housing market's probably not going to be running up quite as much as it had the last 2 years. Supply has dried up quite a bit. And overall, I think the main point is just it's such a massive change. We haven't seen a change like this since the flip side of COVID or the flip side of coming out of 2008. So it's a pretty dramatic shift. Any thoughts you have?
I would say that this chart makes perfect sense following what you previously talked about and what we talked a little bit about, thinking about the pandemic, thinking about historically low rates that were offered there for a couple year period, generational shifts. The chart makes sense. Kind of adds up.
Yeah, it all kind of makes sense with the prior things I mentioned. So,
But a good chart nonetheless.
yes, I think it's a pretty dramatic shift. So again, curious to see kind of as we get more into peak home buying season, spring, early summer, seeing what this looks like, existing home sales, and if this changes at all. I hate to speculate, but my guess is home sales probably increase a little bit, would be my guess, as people get into spring and summer. But I don't know. Could be wrong.
Because being a year-over-year chart, I imagine this will kind of come back
Normalize.
to that normal range where you're having kind of more what we saw in the early 2000s. I would
Kind of chopping back and forth.
that would be my guess if I had to, if someone made me guess.
Absolutely. Any other thoughts or questions on anything I talked about, or you good to go with your topics?
Yeah, I'm good to go. That was all great stuff. I've got 3 for listeners. I'm going to start off with credit card balances increasing. This is a research piece from Compound Research yesterday, actually. And the line that I pulled is as follows. Credit card balances in the U.S. increased 15.2% over the last year, the biggest jump since the 2001 recession. So we've unintentionally themed a lot and research.
We didn't work on this together.
We didn't work on this together at all. This is just mere coincidence. But jumping back into the consumer and thinking about their discretionary income, they have more, and maybe they're pushing those credit card balances. Not maybe, they are pushing those credit card balances a little bit more than we've seen in the past. This is another year-over-year percentage change chart. I personally, I always look at those charts in a different lens, and it takes my brain. I like to see the raw data personally. It gives me a little bit better understanding of the history, but this is a pretty notable jump. Makes sense with everything else we've talked about. So I guess I don't have too much more to say about it.
Yeah, no, the only thing I'll say is the chart makes perfect sense. There was a lot of stimulus, the checks from the government coming out, and a lot of people were paying down debt. Mortgages were, again, at all-time lows. Mortgage rates were at all-time lows in COVID. So inflation wasn't ripping. So it all makes sense that credit card rates are going up, because Americans typically don't change their spending habits, even if things are more expensive. And I think it makes sense that as discretionary income has probably fallen a little bit with inflation being higher, goods being more expensive, Americans are going to continue to do what they do and spend, which is not necessarily a bad thing, as we are a 70% consumption-based economy. It's essential to our economy. But it's never a good thing I'd say, to see credit card rates increasing at this level. I honestly think it could be a factor of inflation, being post-COVID, more people traveling, things like that. That's not cheap. Especially if you look at airline prices and things like that right now, it's, again, a pretty elevated level. So I think a lot of it's a shift in demand from kind of maybe goods to more service-based things going forward. That's maybe a bit more expensive that we haven't had during the last couple of years with COVID as well. So just kind of my 2 cents on it, but it's a great chart. I think it does fit well into our unintentional theme here.
Into our unintentional narrative that we're painting. So for the next 2 pieces, I'm going to step away from the narrative. I'm going to get back more into the financial markets. So the next piece I have is talking about why some market participants are so bearish. This is a tweet from the Twitter profile is called Markets in Mayhem. And this was from yesterday. And just a disclosure, the Markets in Mayhem, they try to find these major charts, and they have a little bit of a doomsday-ish take, I've noticed. Some good charts nonetheless, but just disclosure there. The quote they had is the following: "Stocks could have room to drop further as the Fed's hiking cycle hasn't ended, and even the eventual pivot could lead to further losses, as such an event often happens during times of economic and financial stress. And he has a really cool chart here. The title is "The History Shows Stocks Have More Room to Fall. U.S. Stocks Never Bottomed Before the Fed Stopped Hiking." This is stuff that the market, the Fed hike cycle, and looking at history and looking at the history of the rate cycle in context of the broader financial markets moving. Let's just use the S&P 500 as we normally do.
Right.
This is something that people watch really closely. And this is one of the reasons that there are still a lot of top research shops out there that are somewhat bearish. There are obviously people on both sides of the coin. Some people think that we've seen a pretty big pullback over the past year and a half. This is also a very convenient chart to throw out at this time after such a strong start to the year, when really I think a lot of the market, from the shows I'm listening to and a lot of the research I'm reading, it seems like people are looking for a reason not to buy. People are looking for a reason to just pause and, the whole wait and see approach.
Right.
I'm not going to predict what's going to happen. I'm not going to say that, this chart is going to completely depict what's going to happen and we're going to go lower. It's a good chart to show why some people just a quick look at why some participants are still very bearish.
Yeah. I mean, it in theory makes sense. I always take everything with a grain of salt, right? I do think there could be continued volatility. I think that's likely.
Yeah.
And I think that this chart definitely points to that.
Yeah.
But again, there's always bears, and
there's always bears, there's always bulls.
Right.
There always will be.
That's right. So, I mean, historically, the chronically bearish, let's call them, are usually wrong.
Yep.
Is my feeling. So,
in the grand scheme of things, yes.
Yes. The perpetual bears are mostly wrong most of the time, but they get a lot of media attention when they are right. Right.
When they're right, they really like to pound the table and let everyone know. I'll make two more points, and then we can keep it moving here, because I know we have a financial planning topic to get to. The 2 points would be, the question I still have about this chart is, can we have a soft recession? If we have a soft recession, is that already priced in? I think that's what the market is trying to figure out.
What's unknown.
And the rate cycle has obviously gone up pretty quickly. You can see that in the chart. And if we've already priced that in, then this could look different than some of the bears are calling for. So that's one of the points I'll make. And then the other point I'll make is, this is a great chart. It's a really cool chart, but it doesn't show us a ton of history.
It does not.
I'd like to see
23 years.
Yeah, it only goes back to 2000.
I'd like to see the 80s and 90s and things like that at a minimum.
It makes me think this guy's probably trying to make a point, and I wonder what it looks like going back
long term.
And maybe it's not as beautiful to this guy's point.
Right.
So those are the 2 points I'll make.
Absolutely.
You can
pick the data that looks good sometimes.
Exactly. And I kind of wonder if you cherry pick this just a little bit. I'm sure the general idea is I know the general idea is accurate to some degree, but it does look a little bit cherry picked. The last piece I have is checking in on profit margins since the pandemic. And this is a tweet from Liz Young. She's the head of investment strategy at SoFi. And she says the following: the S&P 500's profit margin has compressed by 3% percentage points, but is still above pre-pandemic. Note sector dispersion. Energy margins 3x what they were in 2019, while financials and big tech-ish sectors taking it on the chin since the 2022 peak. We'll throw this diagram, this chart, table, whatever you want to call it. We'll throw it up for listeners to look at so they can see it, what we're looking at. And it's a good chart. It shows exactly what Liz pointed out, how the energy margins have really come up quite a bit since pre-pandemic. but you can kind of see the dispersion across the sector and which sectors are holding up relatively stable, which ones are moving. One of the big takeaways is that they've compressed by 3 percentage points. General margins have, but they're still above the pre-pandemic level.
I think that's a good thing, obviously.
I think that's a great thing, and I think, let's talk about the bullish side of the narrative. Mm-hmm. That's very bullish, right?
Even as recession fears have loomed, and it hasn't really compressed that much.
Exactly. And we've talked about it. I know Matt and Mark have talked about it in previous podcasts, that there's going to be a lot of focus on profit margins over the past few quarters, and there will continue to be a lot of focus on profit margins while all the recession talk is looming, while we're trying to figure out, is it going to be a soft landing? Is it going to be a hard landing? When will the Fed cycle end? When are we going to reach the terminal level? Profit margins, operating margins, operating efficiency metrics, that stuff is going to be under scrutiny. But to see that the big picture, we're still above the pre-pandemic levels.
I think that, in my opinion, leads me more, if corporate profitability can remain, I think that leads me to believe that there's a better chance for a soft landing if this hit, rather than have this hit crumbled, right?
Exactly. And that's I had the bearish chart earlier. Had to balance it out for listeners. So I thought that was a good one.
Absolutely. No, that's an awesome chart.
Do you have anything else you want to add to that before I sub out for Taylor and she takes us through the financial planning topic?
No, I thought all your tweets were great. A bunch of good info there. It's been fun to do the podcast with you.
Absolutely. Well, thank you, listeners. It's good to do this again, and I'm gonna let Taylor jump in here.
All right, welcome, Taylor.
It's good to be back on the podcast. It's been a little bit.
Yeah.
So today I'm going to be talking about estate tax, just an overview, not going to get too detailed. So estate tax is a tax levied on a deceased person's assets, and this can range anywhere from 18% to 40%. But this only applies to assets valued over $12.92 million. So that's the limit for 2023.
Yeah, that's a pretty large number.
Yeah, and because this exemption amount is so high, most people don't have to even worry about being charged a federal estate tax. So I think that's definitely a common misconception.
Yes.
Also, though, some states do also have estate taxes. So even if you qualify for that federal estate tax exemption, that $12.92 million, you still may not qualify at the state level.
Yeah, that's a great point. And that's why I think sometimes you do see some estate planning techniques that can take advantage of maximizing all the exemptions, and especially with, not to get too technical here, A trusts and B trusts for married couples to maximize the estate tax exclusions, especially on the state level. So I'm glad you brought that up.
Yeah. Trusts are a great way to kind of shelter that tax. Mm-hmm. So estate taxes, they're also assessed on the current fair market value of the assets, not the original value when the asset was actually purchased. So, for example, like if you purchased a house for around $5 million, but its current market value was around $4 million instead, then that $4 million would be included in the estate, not the $5 million.
Good.
Additionally, surviving spouses are not subject to any federal estate tax because of the unlimited marital deduction. So that basically allows unlimited transfers to spouses completely free of tax.
Right. That's good.
Now, going back to estate tax at the state level, there's actually only 12 states that do charge an estate tax. So those include Connecticut, the District of Columbia, Hawaii, Illinois, Maine, Massachusetts, Maryland, New York, Oregon, Minnesota, Rhode Island, Vermont, and Washington State. So even though those state thresholds and rates may be different than at the federal level. There's only 12 states that really charge.
Right. Yeah. So if listeners are in one of these states, it could be something to consider. But for the vast majority of people, estate taxes aren't a huge concern, right? Unless you are kind of what we call ultra high net worth, right?
Exactly. Now, there's also a state inheritance tax, and this is charged to the heirs who are actually receiving the assets. And depending on, if you're an heir, your relationship with the decedent will determine the inheritance tax rate you might pay. So if you're a surviving spouse, you are typically exempt from any inheritance tax. If you are a child of the decedent, you normally qualify for a lower inheritance tax rate. And it's typically somebody who's actually unrelated to the decedent who is charged at a higher level. And this inheritance tax is only charged at the state level, not the federal. And there's only 6 states that actually do charge this tax. So that includes Iowa, Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. And just like with the estate tax, an inheritance tax is only due if it exceeds that threshold or that annual limit.
Yeah, and those states have different levels, correct?
Exactly.
Yeah.
That's why you can be exempt at the federal level, but maybe not at the state level, because every state is
a little bit different. Yep.
There is a couple ways you can minimize estate taxes. A couple really simple ones are just to stay below that threshold amount, which is pretty easy to do. I don't see this too often, but sometimes people make their estate beneficiaries of a life insurance policy. So obviously you don't want to do that, because then that value is going to be included in the estate. And then you also mentioned this earlier, placing assets in a trust just to shield from any tax.
Yeah. I think the life insurance is a great thing to consider, because like you said, if you make the estate the beneficiary of the life insurance policy, it's going to be taxable to the estate if you're above the exemption or exclusion amount. If you make the beneficiaries essentially a person or a specific type of trust, it won't be a tax it'll be essentially tax-free, which is huge. So I always encourage clients to make sure you're listing beneficiaries for life insurance, usually to a person, whether it's a spouse or children, something like that is typically the best route.
Yeah, I don't really see much of a benefit listing
the estate. No, not at all. Absolutely not. Yeah, and the trust can be a really powerful tool. So making things irrevocable, like you said, and keeping maybe a spouse's assets separate can allow essentially you to take advantage of that 12.92 million times 2, right? So you can get that almost over 25 million now, right? So it does take some slightly involved estate planning, but if you're at that level, it's usually worth the expense in setting up the trust and working with an estate planning attorney. So that's a great point. I love that topic today. Yeah,
just a nice overview, not getting too into the weeds.
Yeah, you could spend a month talking about the estate tax and how it's calculated and what's excluded, what's impacted in it as well, because I know the lifetime gift exemption can be a factor. So it can get really complicated, but I love that kind of high level overview. I think that's great.
Yeah.
All right. Anything else you want to add?
Nope, I think that's it.
All right. Well, thank you, listeners, for listening to episode 189 of the Independent Advisors Podcast. We hope you all have a great rest of the week and weekend.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.